Now, to be honest with you, we are currently living in the best time to ever get rich online. And well, I assume that's why you're watching this video. Now, to some of you who may not know who I am, well, I'm Daniel Ashweze, a 24-year millionaire day trader, and I've been trading close to 5 years. I have generated hundreds of thousands of dollars entirely through trading. And more to that, I've been able to teach thousands of students to make money trading. Now, my purpose of doing this video is to teach you on how to start trading completely from scratch. I'll show you what to do straight from the beginning, and I'll also take you through the intermediate, and lastly, how you can actually be able to make money. And by the way, I'll also show you on how you can start with as less as $50. Now, without any further ado, let's get started with our course. So, what's Forex trading? Well, Forex trading is the exchange of currencies. You could also call it buying and selling of currencies. Now, this time around, we have it online, and we definitely call it online Forex trading. Unlike Forex bureaus, everything is entirely done online, and that means if you do have your phone or your laptop, well, it's all good. You do not need a Forex bureau to be able to make money. Now, let me give you an example. So this is $100, and then this is 100 Kenyan shilling. So if, say, I went to a Forex bureau with, say, the $100 bill, and I wanted some Kenyan shilling, there's always a difference in between here, because in actual sense, what I'm doing is I am selling the dollar and in return buying the Kenyan shilling. And well, that's why the money is made. Unlike, as we mentioned, you're doing it physically, this time around it's on your phone. And that means whenever you are transacting, say you're buying, someone out there is probably selling, or say you are selling, there's someone out there buying. So the Forex market is a huge global market with over $6 trillion traded per day. I know that's crazy. Now think about it. Different countries, different currency. Say you're in the US, well, the US has the dollar. Say you're in the UK, that's the pound. Say you're in Kenya, you have the Kenyan shilling. So we have different currencies that are always exchanged every day, and that means there's always money in circulation, and that's why we have to tap into our profits. I'll quickly show you some of the results from myself and then people just like you that have actually been able to learn, and they now make consistent profits. So you can see this is an account, and I made over $6,000. Now this is crazy. Just a few online businesses will actually generate this much. And then more to that, this is an account of just $100, and I was able to make up to $350. So you can imagine you're trading off with just 100, and you have tripled it up in just a few trades off here. Now that's actually 300% returns on just that account. Now, this being my results, let me show you results from people, other traders, just like who you are going to become. Well, over here we can see this is actually inside my Australian community, and there's an account of about 3,000. This person made up to that's about $600, and then we also have more. So you can see we also have an account of $28 and is able to make 42. I know that's crazy. Now, just a quick disclaimer, your trading results will always vary. More to that, I'm not a financial advisor. I am just sharing with you what I have learned along the way and what has actually worked for me. Now, when you are trading, you need access to the Forex market. Now, if I could do an illustration, say you are the trader and then we have the financial markets here, we need an intermediate in here, and that's where the Forex broker comes in. Choosing a broker really comes down to you as a trader, but there are very important conditions that you must consider before choosing one. And firstly, off here we have regulation. All brokers must be regulated unless it's unlegitimate. But think about it. I don't think you'd want to deposit your money or transact with a broker that's not regulated, honestly. Then next up to that, the types of markets that you'd want to trade. Now, in this example, we are trading the Forex market, but then there are also brokers that do offer the stock market and then the crypto market. So it does come down to you as a trader. Will I need to trade the Forex market only, or I would also want to trade, say, the crypto and the stock? And then more to that, we also need to look at initial deposits. Now, I was interacting with a trader and he was asking, how much money am I supposed to start off with? And honestly, it's up to you. But then the broker is always going to place something big in here. Now let's assume you wanted to start off, say, with $100 only, and then for this broker the minimum deposit is, say, $500. Well, more often enough they won't allow you to deposit and they won't allow you to trade. Personally, I only recommend using a broker that allows even the least deposits, because you could want to start off say with $50 or $100. The next up we have spreads, commissions, and then other fees. Well, the broker being the intermediate, they only make money when you are transacting. Whether you're buying or selling, they always have the differences in there. And actually, as I shall discuss in the next minute, I'll show you what spreads are. But when you are choosing a broker, go for one that does have tighter spreads, because that's why the broker makes money. If the spreads are too wide for you as a trader, well, more than enough, these guys are actually making more money off you than you make in return. And then the next one is transaction rates, among others. There are actually so many. Now, I did all the research. I don't want you to go through all that confusion of having to research and all that. So I did attach a link down to the broker that I personally have been using for the previous 2 years. Now, that's how you choose a Forex broker. Now, having understood what a Forex broker is and what to consider when choosing a broker, now we shall go over to opening up an account. Now, once you click the link just down in the description, you'll come over to this page. Now, off here you have sign in, but for our case, we shall go over to create an account, okay? So you have country of residence, email address, password. Honestly, this is pretty easy. You just have to fill in your details from your email, your country of residence. And if I could give an example, by the time of recording this video, I am currently in Uganda. So I'd come over here to country of residence and choose Uganda. Pretty easy. And then once you're done with all that, you'll come over to continue. And now, when you are done with all these details, your account is fully ready. Now, at a later stage, you'd have to verify your identity. Well, this is done to honestly prevent fraud and all that. And it's really easy. You just have to submit your national ID or your passport. And honestly, that's pretty easy. Now, once you're done with that, you can finally sign in, because once you have an account over there, you could open up a demo account or a real account, and I'll show you that in a minute. So once you come over here, now you have the option of signing in. So you could come over here, sign in, and I'll show you how it looks. Now off here you can see options. We have real and then demo account. Now a demo account is honestly just a practice account where you're going to do your practice. Honestly, here you're not even depositing money, you're just using virtual funds to test out your trading skills. Now keynote, you're not making money here. All you're doing is practicing. So just come over here, and so you could say open up an account. And we have standard, we have pro, we have raw, but I would recommend a standard account firstly, and then you come over to continue. Okay, now here you have options. You could either choose MT5 or MT4, and then you also have leverage. I'm going to explain that in a minute, but for the leverage I would say use 1 to 500. Doesn't have to be too big and it doesn't have to be too small. And then for the currency, honestly this depends on where you are. I personally prefer trading in the US dollar. That means when I'm depositing or doing all my transactions, I'm doing all that in the US dollar. That's an option. You could decide to trade in your local currency, because at some point it makes more sense. And then nickname, again, pretty easy. Fill in your nickname or your real name and then password. And you now have a demo account. This is the same process that you could actually use even on opening up a real account. Same thing, just switch up and you have that. Actually, for a demo account, the biggest difference, as how you guys can see, is the starting balance. Off here, you're not even depositing. I mentioned that. Now, something to really take most importantly here is when you're trading on your demo account, I would recommend that you trade with an amount that you could possibly start off with on your real account. Like, it doesn't make any sense if say you started up with $5,000 on your demo account, but in actual sense, when it comes down to your real account, you're going to trade with $100. Like, it doesn't seem realistic. So stick to that. Now, having created your first trading account, it's now time to interact with the Forex market. But firstly, let's understand the keywords used in trading. Now, number one, we have what we call a currency pair. Well, as how you can see, it's a pair, and that means it's a combination of two currencies. An example could be GBP USD, it could be Euro USD, it could be GBP JPY, and USD JPY, and many more. So what's happening when we are trading is we have two transactions all happening at a go. And that means, say you had the dollar and you wanted the pound, you would get the dollar, deposit it, say to a Forex bureau or something, and then you'll get the pound in return. And that means you are, in actual sense, selling the dollar and buying the pound. So we have two transactions happening all at a go. And that's why we call it a currency pair. On the other side, you could even call it a quote. Examples, so we have the Great Britain pound against the dollar, and this is how it's illustrated. We have the euro against the dollar, we have the pound against the yen, we have the dollar against the yen. Now, currency pairs are divided into three types, okay? So firstly, we have major pairs, and these are the most traded. And for a beginner trader as you, I would recommend that you put more emphasis on this. So examples, we have Euro USD, we have GBPUSD, we have USD JPY. Them being the most traded, honestly, again, on the other side, they're easier to analyze. Next up, we have cross pairs, and these are made of major currencies other than the dollar. So this means these pairs have major currencies in, but the dollar isn't in. A clear example could be AUD CAD. We have AUD JPY, and so on. Actually, this is an assignment to you. Once you're done with the video, I'd want you guys to go over this and generate as many currency pairs as possible. And lastly, you have exotic pairs. Well, these are currencies from emerging economies. We could have an example of the dollar against the rand. That's from South Africa. Now, the next keywords that I want you to understand are the ask price. Well, this is a price where a trader is willing to sell at. Remember, we said when we are trading, we are either buying or selling. And that means you must have an established price where you are ready to say sell at or buy at. Now, the ask price, as we mentioned, is a price where you are willing or say the trader is willing to sell at. Then the bid price is just an opposite of the ask price, and this is a price where a trader is willing to buy a currency at. Now, the difference between the buying and the selling price is what we call the spread. Now, when you are using MetaTrader 5, I'll show you that in a minute, you can actually see spreads. Actually, you could see the buying and the selling and then the spreads too. So in some way, you do not even have to do all the math and all that. A key point about this is when you are choosing a broker, you guys remember I mentioned spreads. Now, if the spreads are too tight, that's good for you as the trader. It's actually favoring you. But then on the other side, if the spreads are huge, well, that's favoring the broker. And that's why we said when you are choosing the broker, you need to find one where spreads are tight. Now, next up is leverage. So this is the use of borrowed capital to increase one's buying power. Now, I'll give an example. Say you're trading off with $100. Now, $100 could seem small for you to carry on a transaction, say with gold, because gold is probably at about $2,000 plus at the moment. So when you're trading with $100, it's really hard. You can't, even $500 or something. Now, what happens is the broker is going to come in, borrow you some capital, okay, and you'll be able to carry on those transactions. Now, I do have an illustration here and I'll show you. Now, we assume your initial capital is $100, and then in between here we have your leverage, and we mentioned this is from the broker. Now, you guys remember when we were opening up a demo account, I showed you this example. Now, in this particular example of here, we have a leverage of 1 to 100. Now, that means your final trading power is going to be your initial capital, which is $100, times your leverage, which is 1 to 100, and final trading power is going to be up to 10,000. Now, that means you could be using $100 as your initial capital, what you deposited to your trading account, but because of the leverage that you are using, you're able to place bigger positions. Now, key note of here, the bigger the leverage, the bigger the risk. And actually, for some brokers in countries like the US, the maximum leverage is, I think, 1 to 200 or 1 to 20. I can't remember clearly, but most countries will even regulate this because they truly understand the risk with this. So on the other side, when we are trading, keep your leverage in there. It doesn't have to be too big and it doesn't have to be too small. Let me give you an example. If say it was 1 to 1. Well, if say you're using a leverage of 1 to 1, that means you are trading with $100 with a 1 to 1. That means you are using your exact capital to honestly place trades. And in some way, this could limit you. I mean, you may not be able to trade or open up more positions because you're just using $100. So that's really important to understand. Now, next up, we have buying or going long, or you could also call it being bullish. Now, remember, again, concept is buying and selling. So buying is when a trader opens up a trade expecting the pair value to increase, i.e. we buy low. So we are buying when the price is low, expecting to profit as the value increases. On the other side, we have selling or going short. or being bearish. So in here, this is when a trader opens up a trade expecting a pair value to decrease, i.e. we sell high. Now when I was starting off, this was really hard for me to honestly understand. So what I got in mind was, okay, we have bullish and bearish. So when it's bullish, expect a bull to push the price up, and then when it's bearish, expect bears to push the price down. That was a really easier concept that helped me understand this. Now, keynote off here, remember, we buy low and sell high. Please take note of this and keep it in mind. Now, next up, we have stop loss and then a take profit. So a stop loss is an automated lever that closes off a trade once it goes against the initial trader's prediction. Now, honestly, we have losses in trading, and you need to understand that, because sometimes you could anticipate that, say, the price is actually going to go up, and what happens, it does the opposite. Now, a stop loss is going to protect you from further losses. In such a scenario, if say you opened up a trade going to the upside, say you opened up buys, and rather than the price going up, it reversed to come back down, well, if you didn't have a stop loss in position, that would become a huge loss and perhaps maybe blow up the whole account if say you didn't have this on. So what happens now is, whenever you are buying, you're going to have your stop loss below the price, okay? And when you are selling, you are going to have your stop loss somewhere up. Now, obviously, as the trade goes in profit, at some point you could decide to even extend your stop loss close to your entry or even into profits, and we call that a break even. In such an instance, you have your profit fully secure, that even if the trade reversed and did all that, you are going to close off with profit. Now, next up, we have a take profit. Take profit is just the opposite of a stop loss. So in here, it's an automated level that closes off a trade once it hits the trader's desired profit level. Assuming you're not even watching the charts and all that, you're so busy, all you have to do is set your take profit, and once the price hits that level, you will find the trade close, your profit all secure, without having to do a lot. Well, in here, what happens is, say you are buying, you would have to place your take profit somewhere above, okay? Either side, if say you are selling, that means you expect the price to go down, and you'd have to place your stop loss somewhere below, because now that's your profit side. Now, these are actually very, very important when it comes to risk management, which is a detailed topic that we're going to discuss in the next few minutes. If you're not using this as a trader, well, more fair enough, you're gambling, and trading is not gambling. So be sure you always have your stop loss and take profit levels in place. Now imagine this is the amount of money that you must put to open and hold a trading position. Well, this money acts as a collateral to the broker. Well, again, back to what we said, remember you deposited the money to the broker, and for you to be able to open up, say, a bigger trading position or any position, the broker needs to have something as a collateral. Remember, you used the leverage already, so in actual sense, the broker has borrowed you something. Now they need something in return, and that's why the margin comes in. So this is going to act as a collateral, meaning if your margin is really too low, well, the broker may not even allow you to open up a position. So we have used margin, and this is the amount of money that you use to open and hold a position. Then the free margin is the amount of money available to open up newer positions, okay? So this is really, really so important, and as a trader, you must consider this before opening up any extra positions. On your MT5 app, those will always be displayed from the equity to your margin to your free margin, so it's easier for you to keep track of that. Now, a pip. So this is the smallest unit in measuring currency pairs. And now that brings us to the next term, and that's a lot size. So a lot size is the number of currency units being traded in a forex position. Well, a pip, a lot size, all these are units that you'll basically use a lot in your trading to establish how much money you intend to make or how much money you intend to risk on a single trade. And I'll give you a much easier example as we go trading live on MT5. Now that you understand the keywords used in trading, let's go ahead and understand the apps that you need to be able to start trading. For this particular example, I'm going to be using my iPhone. Now, you're just going to come over to App Store, okay? And then just type in MT5. There we go. So you'd have all these show up. So we have MT5. We also have TradingView. Oh, by the way, you can also just install it by the time you're watching this. Now that I have it installed, I'll just go ahead and open it. And there we go. So whenever you open it, this is how it's going to look. So this is default. No account signed in, no nothing. So we have welcome to MetaTrader 5 and all that. Then just go ahead and accept, okay? And then open a demo account. You guys remember what I mentioned? We said a demo account is a practice account, and that's what we are dealing with here. So they show you, well, can open a demo account, and you could proceed and say, yep. And oops, this is a bit detailed. We could cancel that. And we have two options here. Now it's redirecting us to this page here. Now it does show you broker. Now remember, we had created an account. Either way, we still needed it. What we are going to do now is link the broker, okay, the account that we had created with MT5. So let's just quickly go over back here to our broker, and then we shall quickly sign in and see how it's looking. So back here, let's check our demo account. All right, perfect. So we had created this account with Excellence, okay, that being the broker. So we shall come over here and type in, okay, so we are coming to this section and typing in Excellence, okay. To actually make it easier, now you can see we have a whole ton of Excellence profiles showing up. So we need to understand which of these is the one that we are supposed to use. So honestly, the easiest way is to come over here back to your account and then look for the account information, okay? There we go. So we have server being Excellence, MT5 trial, you know, all that. So that's what we are going to be dealing with. So we could go ahead and write in Excellence MT5. There we go. So we have Excellence Technologies. Then MT5 Real 17. We are dealing with MT5 trial. You guys understand? So we shall go ahead and search out for, okay, trial 10. There we go. So we have it. You guys see that? Then the login, our login is going to be 207419182, and then the password I'd created that when I was opening up the account. So once you've entered your login, just go ahead, proceed and enter your password, and then we should be good. There's a mistake with the login. Okay, now just a quick one. It does seem I'd entered the wrong server. Now that's key. By the way, most traders have always struggled with this. More than enough, if you enter wrong server and say use the right password and the right logins, the account will show invalid account, so you can't log in. So I'll quickly make an update of here. So the server is MT5 trial 9, okay? So this is it. So we have trial 9 off at this point. So I'll go ahead and click on that. And then the login is going to be 2074. Then we have 19. Then we have 182. Then I'll fill in the password. I'll just blur that out shortly. All right, perfect. So we now finally have our account. Pretty excited. So you guys can see we have the balance, we have equity, we have free margin. Now let's leave all that and shortly understand how the platform works. So down here we have quotes. So I'll click on that so you guys can see. So quotes again is just another word for currency pairs, okay? With what you guys can see, this is BTC USD. So that means it's Bitcoin against, say, the dollar, but we can go ahead and customize it. You decide which pairs to add. So come over here and say search. So here you could see GBP USD and then click on the add, and there you go. So that means we have now added GBP USD. So that's the pound against the dollar. So you could even go ahead and delete some of these, because personally I wouldn't even trade these. So there we go. I could also go ahead and add other pairs as USD/JPY. Then I could also add Euro USD. Honestly, pretty easy. So you can add as many pairs as you wish, but for now we have 3 pairs. So we have GU, we have USD/JPY, then we have Euro USD, okay? Now, next up, we have this section off here, and it's the chart section. Now on the chart section, that's where we are doing our analysis. As we shall see just in the next few minutes, shall see how these charts are read and all that. But whenever you're going to trade, you need to understand how the charts are behaving so you're able to get a trade. And that happens within this section, okay? So you can see over here, we have red and green so-called candlesticks. And then next up we have this section off here, and it's a trade section. Now that's why we started off here. You have your balance, you have your trade, your equity, your free margin. Now if you opened up a position just right now, then all your trades are going to reflect off here. And that's why we have that section. Then lastly, we have the trade history. Now within the trade history, all your trades reflect here. Rather, your history of trades. Say you took buys and sales and stuff, all that's going to show up here. Your profit or loss is all going to show up here. Your deposits and withdrawals is all going to show up here. So you can see we have deposit, we have profit, we have swap, commissions, and then balance. Again, the broker that we are using doesn't take any commission, so this is always going to stay zero, even with a real account. And then lastly, we have settings. On the settings part off here, that's where you can always change the accounts. Just an example, right now we are logged in with a demo account, but now if I wanted to log in with a real account, I'm just going to come over to this section, click off here, and then come to the plus button, and there we go. Again, same thing, enter company or server name. Again, say we are dealing with excellence, but then this time around a real account. Depending, honestly, just like how we did at the first scenario, it's the same thing that you're going to be able to do here. And with that, you would be able to have your platform set up. Now, let me quickly show you how you can actually take a trade using this platform. So all that activity happens within the chat section. So we have these two buttons off here. So we have this, and that's the instant orders. Say you want to open a buy instantly, you're going to come over here, click the buy, and then your position would be open. Same thing, sales, you're going to come over here, click sales, and then the trade would be open instantly. Now before you do that off with the MT5, you have to accept the terms and conditions, so just come over here and then you'd be good. Now either side off here on this platform, we have what we call pending orders. Pending orders now are just the opposite of instant. Now what happens is, say you expect the price to sell whenever it reaches a point, you could place a pending order at that point, that whenever the price gets to that area, your order will be executed instantly. Well, with that means you won't even have to stay on the chart and wait for the price to hit, say, a given level for you to be able to open up a trade. And that's the good thing about this whole thing. So we shall go ahead and just open any random trade on GBPSD. This is what we are trading right now. So we shall go ahead and open buy. So we shall click buy, and there we go. Now when you have your position open, it's going to reflect as how you guys can see off here. So we see buy 0.01 lots. Okay, this figure off here is always the lot size. Remember what we mentioned, it's much more of like a unit. And then whenever you want to track your positions, you're going to come over here, and then there we go. So you have your position running. So all that is always going to reflect within the trade section. I wanted us to do a quick comparison with the lot sizes so you guys can understand how they typically work. Now this is a position of 0.01. Now I want us to go ahead and open a slightly bigger position than 0.01, and then you guys will see. So let's go ahead and adjust the lot size off here to say 0.1 and click buy. There we go. You can now see the difference. So this was 0.01 lots, and now this is 0.1. Now you can see we are currently in a drawdown or a loss of $2 on this 0.1. Then on the other side, we are in a small loss. Well, either side, even on the profit side, it's the same. When you are in profit, you're probably going to make more money with a bigger lot. Now, please take note. I'm not emphasizing that, oh, even if you're trading with a small account, open bigger lots because you want to make huge profits or something. No, your lot sizes must really stay minimal. If I could give a very brief example, you see we are trading with $500. In actual sense, with this account, we can only use 0.05 as our maximum here, but I shall discuss that when we come to risk management. So typically you have these positions running. Again, if you wanted to close them, it's really easy. Two options: you could either long press and then come to close position, and then off here you can say close, but I won't close them now. I think we could use them later. Same thing, you could just scroll to your left, and then you have this yellow tick and say same thing, come over here and then close, and at that point your position would be closed and it would reflect here. Let's actually do this. I'll show you. And there we go. So we have now our position reflecting here. We were trading GU with a buy and we made $0.02. So using MT5 is honestly easy. It just comes with practice. The more actually you use the platform, then the easier you're going to get. So good with it. Actually, even if say you use huge screens to trade, I don't know if you guys have seen those huge, screens, still you'll need such a platform because it's easy to use, it's mobile, and it's easily accessible. And that's why most traders actually prefer using MT5. And with that, let's get to our next platform, and that's going to be TradingView. Now, just a quick update, you guys remember I mentioned you could also install TradingView on your phone. It's again really easy. Let me see if I do have TradingView here. There we go. So we do have it. Now, TradingView is a platform that most traders use to analyze, okay? Now, remember, you're trading, you need to know how the price is behaving. And now, rather than using MT5 with these charts, most traders find it easier to use TradingView for the analysis and then MT5 for trades. And then more to that, TradingView does have a few disadvantages on the other side, and that's to do with brokers. TradingView only allows just a few brokers. And like with MT5, you can link literally any broker. So that's why on the other side, some people decide to say, well, I'll use TradingView for my analysis, but then for my trades, I'll use MT5 because it's much more easier. So same thing off here now. On TradingView, we have your watch list, and then we have the chart off here. You're doing your analysis and all that. Then we have these other futures. Honestly, not that important. We have ideas. I personally never use this, but for a beginner, you can always go through, see what other traders think. So off here, you can always scroll, learn a few things in there. So for TradingView, they basically have free and paid packages. So you can decide to either upgrade, but I would say this is all good. As long as you're able to analyze and get a trade, it's all good. More to that, some traders prefer to use the desktop version of it because I would say it's also much easier to use. And let me quickly show you how it looks. Now on your desktop, it's really easy. Just come over to tradingview.com. So if I just did that, now there we go, same thing again. I'm already logged in, so I wouldn't have to log in again, but all happens here. Now the most important part here is you're going to come over to products, okay, and then super charts, and then click on that. And there we go. Now, TradingView also offers you a variety of options. You can always decide to customize it. To some traders, you'll probably find, say, green and red candlesticks. Some other person you'll find black and white. It does depend, actually, from what you wish. In this example, we have green and red. If you wanted to make changes, just come over here, right click or on your computer, and then come over to settings, and yep, you have all these options. So you can decide to change these colors, which is pretty easy. Again, off here, some of the most important tools can be these entry positions. So we have long. Remember, we said when you are going long, you are buying. So that means you could use that, place an entry, and there we go. Also, you placed it off here. Now, the red side is the stop loss. You guys remember what we said? We said our stop loss is going to automatically close a trade if it was going against your initial prediction. And that means if, say, we opened up buys, we expected the price to go up, meaning if in any case it just decided to come back down, we have to set a point. Say we set our stop loss up to this point, that whenever the price hits this area, let our position get closed automatically. Now, to some of us personally, what I do is I may not use TradingView specifically to place the trades, but I'll use it to get all the figures. In such an example, I do have my stop loss as 1.26403. So I'll get this figure, copy it, and then go paste it over to my MT5, which is honestly really easy. You can always keep TradingView as your tool to analyze, and then MT5 specifically for your entries and then monitoring your positions. And those are the two tools that you specifically need to execute trades. Now the next one is an economic calendar. So what happens is in trading, we are dealing with currencies, but then currencies are affected by economies. Meaning if say there is more employment happening, say in the US, that's going to directly affect the dollar. Now what happens, as in for us traders, all we need is to monitor. We need to know what's happening next, what's happening this week. And by the time of filming this, we have an event called NFP happening on a Friday. So with that, I would know that, look, we have NFP coming up on a Friday, and then I would be ready to trade that. So we can easily do that by having an economic calendar. And for this instance, we are using Fastbull. So just come over here and then type in Fastbull. Again, you can easily download the app. I'll put the links just down in the description. Now, once you're off here, you need to have your economic calendar. So just come over here to products and then scroll to economic calendar. There we go. So just like today, do have events on the Canadian dollar. We have events on the dollar. This is at 6 p.m. with the time zone that I'm in, that's the East African. And then we also have events on the Canadian dollar at 5:30. Actually, using the news events to trade is called fundamental analysis. We shall discuss that a bit in detail later on. So typically, again, I can even be able to find events happening tomorrow by just clicking on tomorrow. And if I also wanted, say for this week, again, same thing. And there we go. So you can scroll through and you have a whole ton of events. Again, your economic calendar is very, very important. And by the more to this, you could even also be able to trade. Then we have charts. Off here, you're interacting with other traders just like yourself. You can see this. But then the most important part, again, is going to be with the news. Typically, once you have the economic calendar, you need to also turn on notifications. Now this is how important it is. Oh, by the way, with my trading routine, first thing early in the morning is check news events. What could be happening today? Let me give you a scenario. Now say you analyze and you thought of buying GBP USD, right? And then out of the blue, we have an economic event happening which contradicts what you had planned. Well, what happens is the trade is going to go opposite of your direction. Now you can only be ready for that by having an economic calendar and having real-time events. And that's why it's really, really important to have this. Now we typically have many types of charts, but most traders mainly focus on three, and that being the candlestick chart, then we have the bar chart, and then lastly the line chart. This is a bar chart on GBPUSD on the hourly time frame, and this is how it looks. So a bar chart is a combination of just bars, and this is how it looks. We have the green ones and then the blue ones. The green ones in here represent buyers, okay, or bullish, the price is going up, and then the red ones represent sellers or the price going down. Now a line chart is just a line graph, as how you guys can see. It just shows you how the price is moving. This other side is the price, and then down off here is time, okay? Same thing even with the bar chart. This off here is the price, and then down off here is the time, okay? And then lastly, we have the candlestick chart. Now a candlestick chart is just a combination of so-called candlesticks, okay? And this is how they look. So in such an example, we have blue ones representing bullish, okay, or buyers, and then we have gray ones representing bearish or sellers. Remember we mentioned it doesn't matter. You could decide to set this to your colors or preference. An example with what we looked at before, we had green and red. So it doesn't honestly matter. Now, most traders use candlestick charts, and for this course we shall mainly focus on candlestick charts because they're honestly much more easier to read. I mean, if you could compare this with, say, this bar chart or a line graph is also good, but it leaves a lot of information behind. But for candlesticks, you tend to get even the smallest details, and that's why most traders choose to use candlestick charts. And with that, let's understand what a candlestick is honestly. So candlesticks are a technical tool that displays the price movement of an asset over time. So it's just a technical tool. And by the way, as how we shall discuss, we shall look at what we call technical analysis. That's why we decided to use technical, okay? Then a series of candlesticks form a candlestick chart. Now, we basically have two candlesticks. We have a bullish and a bearish candlestick. You guys remember what we said? It's either the price is going up or going down, and that's what these two come in. So we have the bullish and then the bearish. Okay, now the size of the candlesticks indicate how much momentum is currently in the market. Huge candlesticks indicate more pressure and vice versa. Obviously, for the small ones will indicate less pressure in the market. Now we shall see more examples about this, but if say you saw a huge long candlestick, that means we have a lot of momentum at that point with the price. If say it was bullish, it means buyers are pushing the price insanely. And say if it was bearish and it's long and huge, well, that means sellers would be in with a lot of pressure. Now, this is an example of a bullish candlestick. Please, keynote, again, I'll go back and recap that. We said bullish is when the price is going up, meaning it's opening low and then closing higher. I want to show you an example, but it's really important that you guys get this concept even before we get to the charts of here. Now, with such a bullish candlestick, this is how it's going to look. So we have this green part of here and it's called the body, okay? And then we have these green lines or something, those are called wicks, okay? So we have a wick down, we have a wick up, okay? Now, this point down of here is the opening price. So remember, it's bullish or the price is going up. Well, on the other side up, this is the closing price. You guys understand? On the other side for bearish candlestick, I just indicated it in red. We have this being the body, then we have this being the wick, again, same example, and then this being the wick. All right, in this example now the price is going down. You guys understand? Now what happens is this time around we have the opening price on top and then the closing price down. Why? Because we are bearish. That means the value is going down. Now here's a case study on GBPUSD on the H4, and this is how it looks. So again, we said we had a series of red ones being bearish or sellers, and then we had bullish ones being green. In such an example, this is typically how it looks. Feels like rocket science, but I believe you guys should now be getting the concept easily. So again, pretty easy. You can see it's just a combination of many candlesticks. Now it takes time for each candlestick to form, and that's what we call a time frame. Now I'll give an example. Say in this particular example, we were watching GBPUSD on the H4. H4, that means 4 hours. Well, in this example, it means it takes 4 hours for one candlestick to fully form. Okay, well, that means it took 4 hours for this one candlestick to form, took 4 hours for this one candlestick to form, and each of these. Same thing if say we were watching the chart on say the hourly. That means it takes 1 hour for each candlestick to form. And sometimes you could even be watching your charts on say the M5. I'm going to show you. On the M5, it means it takes 5 minutes for each candlestick to form. Time frames are really important. We shall see why and how we can actually use them when we are trading. Now, an example of here, as we viewed on GU, we've just seen that. On your trading view, this is what happens. We have time frames often within this section. So you can always select this. Let me quickly go over to trading view and then I'll show you how it looks. All right, perfect. These are the time frames of here. So we have minutes, we have hours, we also have days, and then there we go, we have ranges. But most importantly, we can always consider these minutes, hours, and then days. Now in such an example, we are currently on the M30 on GBPUSD. That means it's taking 30 minutes for this candlestick to fully form. Now if we went over to the M5, it means it's going to take us 5 minutes for this one candlestick to fully form. Currently it's 15:57, meaning the moment it clocks 16:00, we shall have new candlesticks forming on the M5, on the M15, or actually even the M30 and then the H1. Now time frames play a very big role, and this is what happens. So we have 3 types of traders. We have scalpers, we have day traders, and we have swing traders. Now, scalpers typically hold their positions for a short while. It could be minutes, it could be seconds. Then day traders tend to hold their positions for hours. Could be an hour, 2 or 3, but entirely during day. And then lastly, swing traders. Swing traders tend to hold their positions for a very long time. It could be days, months, or even years. Now, keynote, most traders are day traders. We typically hold our positions entirely during the day, make money, and then close off. Now, how do time frames play a big role in here? So if say you are a swing trader, right? You are looking at holding positions say for a month. Well, what happens is sometimes you might need to look at the charts on bigger time frames. Meaning, in such an example, if say I was a swing trader, I'll probably have to come up to say 3 months and see how has GBPUSD been looking like on the 3 months chart. And there we go. If I saw this, I would know, oh, it's been bearish. I should probably be looking out for sales. Same thing, if say I was a day trader, I'll give an example. I personally day trade. I will always start off say from the H4, 4 hours. 4 hours is actually huge. I need to see how has the price been behaving in the previous day. And I'll give you an example. So say this is GBPUSD and we are currently on the H4. Yep, with what I can see, this is how the price has been behaving, pushing a bit up. This gives me a picture. Now, on the other side, scalpers, remember we say these are holding positions for a few minutes or even seconds. Now sometimes they will even go to say just 1 minute. They want to see how is the price behaving, even on the smallest time frame. Note, whenever you scale down to the smallest time frames, you tend to have the smallest details. And some traders tend to neglect this, but it's really, really important. As we shall see, whenever you are making entries, it's recommendable that you scale down to the smallest time frames. It could be the M5, it could be the M15 to be able to get entries. Now that you've understood the charts and then you now understand time frames, let's go ahead and see candlestick patterns and all that. Now remember what we said, candlesticks being used as a tool to see how the price has been behaving. Candlesticks tend to have different formations, which are honestly important whenever you're looking out for a trade, and we call that candlestick anatomy. So candlesticks have different size bodies. You guys remember we said if it's so huge, there's more momentum. If it's small, there's no momentum. So they tend to have different bodies. When it comes to trading, it's important for us to check out the body formations of these candlesticks. So then candlestick patterns is a series of 1 to 3 candlestick formations. Now we shall see you could have 3 candlesticks all arranged and they will probably tell you something. These are used to study how the price is behaving. Common examples, an engulfing candlestick pattern, just like how the name goes. So in an engulfing candlestick, the new candlestick engulfs the previous formation. And let me show you an example of this. So this is a bullish engulfing pattern. Now what's happening is we had this red candlestick. Remember we said this is for sellers, okay? So this was bearish. And then out of the blue, we have a huge bullish candlestick forming. More to that, it's enclosing the other previous candlestick body. In such an instance, we would say this was a bullish engulfing candlestick. This is it off here. Same thing for a bearish. We initially say had a bullish small candlestick. There we go. And then we have a big bearish candlestick forming, but then more to that, it's even engulfing the entire body from the previous candlestick. Well, that would be called a bearish engulfing candlestick. So whenever you see an engulfing bullish candlestick, it could in some way predict that, okay, look, the price is reversing and it's going to continuously push to the upside. Why? Because we saw this huge bullish candlestick, meaning buyers were getting in hugely. They got in and initially had to oppose the sellers and close above the previous sellers, okay? So in such an instance, you would get in with buys if you're given a right confirmation. Same thing for the bearish. Say out of the blue got such a bearish candlestick. Again, this would mean that sellers are getting in hugely and they're moving the price to the selling direction. So off here, you'd come in with your selling orders with the price pushing down. We also have indecision candlesticks. Well, these indicate that there's an inequality in the market and there's some indecision, okay, on where the price to head next. Typically, what comes in here is at some point we have buyers and sellers, and they're all opposing each other. These guys want to take the price to the upside, but then these guys also want to take the price to the downside. And at some point, you could find the volume is almost equal and they can't decide who is going to take the price at next point. And this is how we should expect a candlestick to look. So a doji, okay, is an example of an indecision candlestick. So you can see it's a very, very tiny body, okay, and then with wicks over the other side. If you saw this form, you need to ask yourself, what was the price initially? So we initially had a downtrend, and then out of the blue, we have this formation. This should bring something to you. I mean, initially we had sellers in control pushing the price down, and then all of a sudden we have this indecision, doji, right? Maybe buyers are coming in and they're trying to oppose these guys. More often enough, actually, we shall see this is a reversal pattern. Whenever you see this, sometimes we have a reversal coming. So you'll probably see the price changing direction and pushing to the upside. So this is an example on Euro AUD on the H1. H1 is the time frame. And there we go. So we initially had the price pushing to the upside. We actually have many examples of here. This also is a doji. We also have this. It's a good one off here. See the price got off here, we had this indecision, and boom, we had a sell coming through. We also have other examples, again, same on Euro AUD H1. This is really, really brilliant. You guys can see that. Whenever you see that, you need to keep that in mind. Next up, we have a pin bar. Now, a pin bar can also be called a hammer. This is formed when the opening price is almost the same as the closing price, okay? And I'll zoom in, and there we go. So this is how a hammer looks like. It's like a hammer. Crazy. So we initially had the opening price, and then we have the closing price on the other side, and then we have a long wick down. Now that means we initially had sellers and buyers came in to oppose the movement, and perhaps we should expect buyers coming in. And again, it's also much more of a reversal pattern. Now, a shooting star is just the opposite of a hammer, and this is how it looks. Now, initially this other time we have our opening price off here, and then our closing price. This time around we are bearish. Now, an example, say we initially had the price pushing to the upside, and then we have a shooting star forming. We could expect a downtrend happening. Those are honestly some of the most common candlestick patterns. We also have many. You'll meet most of those on the chart. Remember, please, again, the more the practice, then the better. Now that you've understood candlesticks and how they're formed and how we can always use them to tell how the price is behaving, let's go to our very next topic. Now, technical analysis is the use of previous price data to predict what's happening. Now, I want you guys to take this from me. Whatever happens in the Forex market is repetitive. If, say, the price has initially been in an uptrend and out of the blitz now downtrend, in some way later in the future, such a thing is probably going to happen again. Now, what's happening is we are using the current price data or even the historical price data to predict what's happening in the future. And that's what technical analysis is all about. And with that, let's understand how the price moves, okay? So the Forex market mainly moves in three trends. We have the downtrend, the uptrend, and the sideways. And in such an example, we have this over here, this being an uptrend, the price is trending to the upside. Then this one off here, the price is trending to the downside. And then we have this. It's a sideways, the price is just moving in between this area. Now, whenever you see this, expect buyers or buys coming in. Whenever you see a downtrend, expect buyers coming in. And then when you see a sideways, I personally wouldn't recommend trading, because what's happening is the price is playing in between set two levels and it's not breaking either above or below. And you have honestly nothing to do with that. Now, this is an example of an uptrend on the pound and then on the H4. Now, in an uptrend, we have to see a formation of higher highs and higher lows. Now, in such an example, we have these down here as our higher lows. We have higher low, we have a higher low, we have a higher low. Why are we calling them higher lows? Well, these are lows but in an uptrend, so we decide to call them higher lows. Then on the other side, we have higher highs, higher highs, higher highs, higher highs, okay? The higher highs because these are highs in an uptrend, and that means this high is already higher than this, or this high is higher than this, and typically. Now, for you to confirm that it's a clear uptrend, we should always see a formation of new higher highs. We need to see the price continuously breaking the previous higher high to form a new one, to break this one to form a new one. If this was to continue, we would have seen breaking this to form a new one, just as that. And in such an instance, we would confirm and say, look, this is a clear uptrend. So on the other side, in a downtrend, this is what we deal with. So we have a series of lower highs, we have lower highs, we have lower highs, lower highs. Then on the other side, we have lower lows, lower lows, lower lows, lower lows. Again, for you to confirm that it's a downtrend, we need to see a formation of new lower lows and breaking all the previous ones. In such an example, we saw the price breaking this to form this. We saw the price breaking this to form this. We saw the price breaking this to form this. If this was to continue, we would have seen the price breaking even this to form this, come back to form this. So we would say that this is a clear downtrend. Again, remember, in a downtrend, we are looking out for selling opportunities. The price is ranging between two levels. It's not breaking below and it's not breaking above. So you can see price gets here, reacts off, comes back up here. So we have this, we also have this, comes back, reacts off, comes back, reacts off. On the other side, same thing. Now here we have this level here. Price comes, breaks down, comes, breaks down, stuff like that. So this is a sideways market. Now, if you wanted to trade it, though I wouldn't recommend, you would open up buys at this point because the price is pushing to the upside. Then whenever the price comes back to this point, open up sales to capitalize on that. That's typically the three market movements. Now I'll quickly go over the charts and show you real-time examples and how the price is behaving. So let's quickly go over to GBPUSD. I'll delete all the drawings. This is real time at the moment. We are currently looking at GBPUSD. Now what we are looking out for right now is we can see a downtrend. Why? Because look how the price is behaving. We saw the price break this to form this, okay, break this to form this. On the other side, we see all these levels. We also see this. We can easily confirm that the trend is on if, say, we saw the price again come to break below here, push back, and then continue to the downside. If we can also scroll back and see, there we go. This was also a beautiful downtrend that you guys can see. We had this, we had this, we also had this, we also had this, we also had this. I can also see this other side. We see an uptrend. Again, in an uptrend, remember what we say, we see this, a series of higher highs and the price trending to the upside. We have this area, we have this, we have this. Now what happened is the price started off here. It actually started off here, pushed to form this higher low, come over here to form a higher high, a higher high, a higher high, until we had a reversal. Honestly, a bit easy. You can find as many examples when you are on the charts. After understanding this, we need to understand, is the price going to remain in the same direction forever and ever? I mean, if it was an uptrend, should we expect the price to continuously push to the upside for 10 years or something? No, at some point we shall always see a reversal. And here's what happens. Say we initially had an uptrend. At some point we shall see a change and then a change of structure. And we could see this. Let me quickly show you also on the other side how a downtrend would look like. So we initially had the price pushing to the downside, and at some point we shall see a reversal and the price is finally going back to the upside. And there we go. Now, how do you confirm that this is a reversal? It's so important for you as a trader to understand how these reversals are happening. And by the way, this can also be a trading strategy, and for people who do trade what we call reversals, this is what they look out for. They need to see that, okay, initially we had buyers in pushing to the upside, and then we can now see a reversal, and now they want to capitalize on that and take sales. Such an instance, those are reversal traders. But let's go ahead and see an example of here. Now, this is GBPUSD. We are on the H4 and this is what we are dealing with. We initially see the price pushing to the upside, breaking all our highs. We had all these, the price was actually forming newer higher highs, until it comes back to this point. Now remember, for us to confirm that the movement was on or an uptrend was still on, we needed to see the price to at least continuously push to the upside, just as that, right? Now what's happening is the price gets to this area and then it comes back down off here. Okay, there we go. And rather than breaking above, now we see this type of a change. Now you can't easily confirm a reversal because the price has failed to break above. Nope. I mean, the price could actually come back down here and then finally push to the upside. We can only confirm a reversal if the price breaks and violates the previous higher low. And this is an example. So we initially have that push and then now we see this huge bearish momentum coming in. Then what's happening is the price breaks this point here. So it breaking this point here, this is a very, very important level. So we have break of structure. This also indicates to us a change of structure. Well, why? Because initially having the price pushing to the upside and then out of the sudden now we have already seen this. Another price has also come down to break below this area. And at this point, we shall now say, okay, now we do have a downtrend happening or a change of structure happening. A change of structure, why? Because we initially had an uptrend and now we are reversing back down to a downtrend. Let's go ahead and see some examples. I just saw an example happening with the current price. We could have a good example of it. And there we go. So we initially have a downtrend. We can mark out some of our levels. We have that. We have this. And then we also have this. In such an example, we need to see the price completely break above this area. If we can see that, then we could confirm that, okay, look, we now have a change of structure. We probably have buyers coming in. Not until you see that happening, then you honestly can't confirm that we have a reversal happening. I didn't mention this, but whenever levels are broken, we can always expect retests. And let me show you what. So say we have this as an example. Let's start off with all these. We have this, then we have this, and then we also have this, and then we also have this. Now what's happening in here is whenever these levels are broken, we can always expect retests. And what are retests? Well, this is it. So we see the price comes down here to break this high off here, and it's always going to come back to retest that level to push to the upside. Again, come back to retest this level off here, push even to the upside, come back to retest this level and push to the upside. Actually, you could easily call it break and retest. The price is breaking out, coming back for retest, breaking out and all that. Then on the other side, even for most key levels, if say we had a level as, say we have two areas, and this is a price playing in between these two levels. Whenever this level is broken, we should always expect a retest and then a continuation. Like there's nothing as say the price has already broken out and you want to take a trade immediately. Nope, we are not doing that. What happens is these levels will often be respected with retests, and then that's when you're able to take trades. I'll show you that in a minute. Now, fundamental analysis is the use of economic data to find trades. Remember what we mentioned when we were talking about economic calendars and all that? When we are trading currencies, we are also dealing with economies of different countries. Now, this is going to affect how the price behaves. Now, I'll give you an example that I just mentioned earlier on. If say we had high employment rates happening, say in the UK, that's going to affect the strength of the pound. And that means the value of the pound is going to increase. And that means for us traders, we would consider buying the pound and selling any currencies against it. So what's happening is we are looking at the economic data to be able to find potential trades. This can easily be done by using an economic calendar. Again, I'll give you an example. You could analyze with technical analysis, say you found buys on, say, gold, but with the news we have, maybe negative news. And what's happening is gold is now selling insanely. And that means with all your correct technical analysis, the fundamentals are doing the opposite. So most traders tend to use what we call pending orders. So they will always set orders on the upside and then down Whenever one is triggered, then they're good. Oh, by the way, didn't mention, whenever we have fundamentals happening, we tend to see huge, big moves happening. We could, out of the blue, see a huge bullish candlestick happening, pushing the price insanely to the upside, or see a huge bearish candlestick happening. Some of the most traded economic events is NFP, we call that the non-farm payroll. That happens on the first Friday of every month. Then we also have CPI, among others. Actually, there are pretty many. You can easily monitor those on your economic calendar that you have on your phone already. I personally do not trade fundamentals, so whenever I know that we do have news coming up, I'm going to stay out, because I've not up to now developed a trading strategy specifically for fundamentals, and that's a major takeaway. Now at this point, you now understand the majority of how trading works, and let's cover one of the most important sections. Now, if you didn't know about this, well, this is a whole subject, and this is why it's important. Now, when we are trading, we have two options. You're either buying or selling, and that means you have a 50-50% win-win. I mean, if you're not buying, then, well, most enough you're selling. Same thing on the other side. If you're not winning, you're probably losing. So it's always 50-50. And in actual sense, some other people try to compare trading with gambling, but this is what creates the difference. Risk management. So risk management allows you to manage your trading investment or your capital. You know, I am supposed to risk this amount of money to make this, or I want to make this much money in a month by risking a given amount. So if at any point you do not use risk management, then you're gambling. But for the fact that you are watching the video till this point, please just ensure proper risk management, because it's key, and I'll show you why. Now let's imagine you are trading with an account of $100 and using 0.01 lots. Well, in this example, you make $1 for 10 pips, and then you make $20 for 20 pips. If say you made 100 pips, you would have probably made up to $10. Again, reflecting on the lot size, okay? Same thing if some other person used, say, one lot size for this account and made 10 pips, that's about $100 already on the table. But that's really, really risky. And that's why we really need to ensure proper risk management. Back to it. Now, how do you easily do that? So what's happening is, with this, you have the ability to say, I am going to risk 1 to make 2. And in this example, we have, say, 1 to 2 RR. RR, we mean the first R stands for risk, and then we have the next one as reward. Well, it does mean if, say, you risked 1, you're making 2. Or say you risked 1 to make 5, or 2 to make 10. All in all, your reward must be bigger than your risk. I mean, think about it. If you are risking much to make less, you won't even stay in for longer, because honestly, it doesn't pay off. And by the way, take it from me, there are losses in trading, and they are completely inevitable. You can't avoid them. So the only option is, how am I going to stay conscious, but then in the long run make money? Now let's assume you stick to such an approach where you are risking 1 to make 2, and let's say you took a sample of 10 trades and then lost 5 and then won 5. Now what's happening is, you lost 5R but then made 10R, and the difference is 5R, meaning regardless you took losses, but you still have your account capital on, but then more to that, you've also made money. That's a worst case scenario. You probably have a 50-50% win rate. But now think about it. You say you had an 80 where you are placing 10 trades, winning 8 and then losing 2. That means you have made 8 times the 2, that's 16R, and then on the other side you lost 2R. Difference again, that's about 14. So you make money, because with trading you are looking at the long run. You're not looking at it as, today I want to gamble, make a bit of money and then go out. No, this is a career. So it doesn't make any sense if, say, you made some money today and then lost everything tomorrow. No. And that's where risk management plays the biggest role. So it's very, very important that you stick to such systems. You can easily do this by having a Forex calculator installed on your phone. You can easily get free ones on App Store. Just go ahead, type in Forex trading calculators and you'll have some. Install it on your phone. It's going to ask your trading capital, you know how much you're trading with. Say it's 100. Go ahead, fill in the pair that you're trading. the stop loss. Back to what we mentioned, we said your stop loss is automatically closing off your trade, so it's important with risk management. You don't want to have the trade run until it drains out your account, so that's key. So you're going to fill in your account size, your stop loss, and then the calculator is going to generate the suitable lot size that you're supposed to use. So risk management is really crucial and so important. And I can honestly say, if say you are good with your trading strategy but bad with risk management, then it's going to be so hard for you to stay in. You can make money, but you won't stay in for longer, and those are two different things. And now the next thing that you need to know is trading psychology. So funny thing is, your trading strategy and risk management takes up 40% of your success as a trader, and then the 60% goes to your trading psychology. And now I know you should be wondering, what's this all about, Daniel? And well, this is it. So psychology is specifically the study of human emotions, but now this time around we have trading psychology, and we are dealing with your emotions as a trader. So when you are dealing with money, emotions come in. You guys remember what I mentioned earlier on? I said a demo account and a real account is honestly the same. The difference is one is virtual money, but then the other is real cash. So whenever we are dealing with our own earned money, we have emotions involved in, and this is from my experience in the previous 5 years of trading. So here's what happens. So whenever you are trading, you want to make money, right? But then on the money making part, most people fear losing money. Now we have two things already. We have the fear of losing money, but you also want to make money, right? Now here's what happens. More often a trader is going to make money, but they want to make more because we have the love of money. We want to make more, and we call that greed in trading. And greed itself is a whole dangerous habit in trading. Now think about it. You've made money. Say you're trading with $100 and you've made 10, right? That's 10% of your account already down. And now you want to make more. Well, more often enough, what happens is you're probably going to get back in and even lose the 10 that you made. Why? Because you're greedy, you want to make more. Now, whenever your emotions take control, in actual sense, you are out of the formula. Then on the other side, as we mentioned, we have fear. Most traders fear losing money. Think about it. There's no any business where you are going to make money without risking money. And that's the same thing with trading. What you must understand is losses are part of trading, and I'm just ready to go over them. I'm ready to ensure proper risk management, and I will know this is what I'm supposed to risk and this is what I intend to make in return. With such an approach, you are going to overcome the fear of losing money. Next up, we have revenge trading. Now say you opened up a trade, took a loss, and now you want to make back the money that you lost. We call that revenge trading. Now for this example, you lost money. Remember, we said losses are part of trading, but now you're trying to make the money that you lost back. Now think about it, that's not the only trading day. I mean, we also have the next day as a trading day. So I want you to think about it in a sense of, I took a loss today, but I can make the money that I lost or even more tomorrow, and not specifically today. So what happens for most traders is they'll often go back trying to make the money that they lost, and in actual sense even lose more because they're already under the emotions and they can't take control of their actions. On the other side, we also have excitement. Again, you're excited about the money. Again, it brings you back to greed. We also have over trading. We want to make money, and you think or feel like over trading is going to make you more money, and in actual sense it doesn't. Actually, what works is taking a few good trades and not over trading. So over trading is, I mean, you have your phone, you have your laptop, and whenever you see a trade, you want to take that trade. It's like you're literally taking anything that seems like a trade to you. So it's much better that you take a few good trades. Take 2 trades and you're good. By the way, funny thing, at the moment I only trade once or twice maximum in a day, and I've stuck to this for the previous 3 years now, and that has made me profitable. So the easiest way to go over your emotions and be good at trading psychology is having a trading plan. A trading plan is typically an approach for you as a trader on how you intend to trade, how you intend to manage your risk, how you intend to manage the money that you've made, and your whole trading process. So a trading plan is going to create more efficiency, and in return you won't have to struggle off with your emotions. Now imagine, say in your trading plan you state that you are supposed to trade once in a day, and that's it. So you're going to come over the chart, take one trade, and then get done. And by the way, having a plan is going to systematically improve your trading in the long run. Even away from correcting you with the emotions and all that, it's going to improve your whole trading cycle. Remember, you're having your trading activity, you have your risk management activity, you have emotions that tend to disturb you the most, and then mostly do some journaling. Typically in here, you are writing a history of all the trades that you take. How did I perform? What did I look out for before taking this trade? And currently there are more electronic journals that you could find over the internet. You feed in your information, your broker information, and it's going to do the recording. You could actually find one over the internet. So a trading strategy is basically an approach that you as the trader will be able to use to find trades and be able to make money. Now, a trading strategy can be developed, again, as we mentioned earlier, using technical analysis or fundamental analysis. But for this particular one, we are going to be using technical analysis. We discussed that previously. We said we are using historical or present data to find what's going to happen in the future. And by the way, this is the trading strategy that I personally use. So the number one rule is finding the overall trend. That's key. I need to know, is the price in an uptrend? And if so, we should look out for potential buying opportunities. And either side, if the price is in a downtrend, let's look out for selling opportunities. Now let's go over the charts and then I'll show you. Finding the overall trend can easily be done on bigger time frames, and in this example we shall use the H4, and we need to see how is the price behaving. And from what we can see, we can clearly see that the price was initially pushing to the downside, but then at this point we do have now a change or a reversal, and we can see that the price is pushing to the upside. When you do have your trend, you need to mark out key levels. Now, key levels tend to vary. To some other people, they could say, I'm going to mark out my support and resistance levels, or someone else is going to say, I'm going to mark out my demand and supply levels. And I'll tell you about that in a minute. So for this example off here, let's say we mark out this area off here. In this example, this is a demand zone. A demand zone is an area where we see massive buying. Now, if you can see an example of here, look, we had the price come over into the zone, and then out of the blue, we have huge buying pressure pushing the price to the upside. So that's key. On the other side, you could decide to mark it out as a line just as that, so you'd have that. Then I can also see we also do have one more right around this area. So we could also have one off here. Again, you could decide to mark it as a level, rather line just over this way. Then on the other side, we can also mark out one other level here. Now this time around, this is going to be a supply zone, okay? Why do we call it a supply zone? Supply zones are areas where the price is going to sell massively. You can see the price got into here and then sold off insanely. So when you do have these levels, what you just need to see is the price is back into this zone. How is it behaving? Should we expect the same reactions happening? And let me quickly show you an example off here. We left this out, but this is also key. This is also a demand zone. Again, a key level. Initially, we see the price got in here, bought off, and then it's back. We again saw a huge buying pressure in, and then it's back. So we should expect the same thing. So that's a typical example. Then more to that, as I mentioned, you could also have more key levels off here. Now, key levels are going to help you know areas where we could expect some reactions, because you need to know that this level has been respected, say, previously, and perhaps we could expect the same thing in the future. Remember, we are using technical analysis, so you do not have to make things too complicated and difficult, yet you are just looking at what happened previously and you're able to find what's happening next. I mean, in this example, we do expect the price to at least push up to this point. Now, is this the first time the price has come to this area? Honestly, not. We can see that the price got to this area and then sold off insanely. So we could expect the same thing. But again, back in mind, we could expect that once the price gets off here, we could expect again a huge sell. Why? Because that had happened previously. Now, the rule of thumb in here is you're not going to take trades before you confirm. I mean, now that we have our levels, you just can't jump in and say, oh, I have my trend, I have my key levels, now let me go ahead and take buys. Nope. Next up is you finding confirmations so you're able to get entries. So what I do personally is I'll start scaling down to smaller time frames. So we are currently on the H4. Now we could go over to H1 and see how it's looking. Now this is how it's looking on the H1. Now on the H1, what do I see? Well, I do see a push to the upside. It's a bit of momentum. We see the price is pushing to the upside, but then there's something that I'm noticing. See the price got off here, return back down, okay? And then we are now off here. Well, good thing is it did break the previous high, which is really good news. So in here we can go ahead and put more emphasis on this point off here. Why? Because look, this is a point where the price got and then reacted off insanely. Now how about we see more reactions back to this area and then we have our buys happening. So at this point we could have to wait. If say we scale down to M15, so now in such an instance we just need to wait and see how the price is going to behave off this area, and then we'd be able to take our buys, and then with a take profit up to this point that we did mark out, and then our stop loss just slightly below this area, back to H4, and there we go, just as that. Now a rule of thumb in here is before I take a trade, I always have to go back and cross-check all my criteria. Now again, in such an example, firstly we started off with a trend, we saw the trend is to the upside. Nextly we've drawn out the key levels, and thirdly we went down to smaller time frames to find entries and confirmations, and that's how we'd be able to get our entry. So I'm always going to go back 2 times and see, is this correct, before I can make that entry. Now in this example, say we have our entry at this point. So this being 2640.76, our stop loss would be slightly below this area because this is a key level, so it's important when you're placing your stop losses, and that would be 2631.53. Now, easier way again, what I would do is I'm just going to carry this order, get to my MT5 and then place it, and then I'd have it running. So that's just an example of how I would trade in such an instance. Let's go over and try some other pair. So we shall go over and try say GBP JPY. All right, there we go. What are we dealing with at the moment? Well, from what we can all see is we have a clear downtrend at the moment. What comes into our minds? Sells, because we already see a huge selling momentum in. Then more to that, we could go ahead and mark out some of our key levels. Well, I done marked out all this, but let me go ahead and redo this. So this is a good supply zone. This is also a good supply zone. Remember, supply zones, areas of huge selling pressure. And then we also have one more off here and many more, but these are important. And then more to that, we can also mark out some of these levels. So we have this being the low, the last low that we had to break. So this is a low that had to get broken to form this. Now, what do we expect? Remember how we mentioned with how the price moves, there's a possibility of the price coming back off here, and then we'd expect more sales coming in. Now the question should probably be, so Daniel, are we going to take short-term buys back to this level? No. Why? Because the overall trend is to the downside, and in no way are we trading against the trend. We have to follow what the trend says, okay? So in such an example, let me quickly scale down to the H1. So on the H1, we already see a momentum push, and let me show you how this works. So whenever the price pushes in a momentum phase, it's never a good idea for you to scale in entries at this point. Why? Because we already have orders in. So if you just out of the blue say scaled in right around here and you come in with your sales, more than enough you're going to out of the blue be met with this drawdown. Whenever the price moves down, it's going to come back for a pullback to collect more orders at this point, then push down, come back for pullback to collect more orders, and then push down. So your main idea, you as the trader, is waiting for these areas here, because this is where most traders are getting in, as compared to you getting in whenever the price is already in a momentum push. Nope, don't do that, because it's honestly not a good idea. You're going to be caught up, and out of the blue you're in a drawdown and you can't hold the positions yet. In actual sense, it's a good trade. So back to GJ. So we already see that now this is a huge momentum push. Now this is on the H1. If we go down to M5, M15, you guys can see how this looks. It's really huge. We can already see that we have this series of bearish candlesticks. So at this point, we can't out of the blue decide to scale in sales. Nope. we are not doing that. Rather, what we are going to wait for is for the price to pull back to this area of here and be able to get entries. Now at this point you'd have to wait a bit because you just can't scale in entries before the setup shows up, or set a pending order right around this area and let the price hit that point whether you're watching the charts or not. That would be a much better idea. So it's important that you stay patient whenever your setup is not ready. You could actually do the right analysis and all that, but make an entry before a clear setup happens. And what happens is you're back in a drawdown, or you're stopped out, honestly taking losses, yet you had actually found better trades. So it's key that you stay patient and just trust the process. So again, a quick recap in here. We had the trend first. We had our key levels drawn out. We have seen the levels being broken, and we came down for confirmations. We already see a momentum push, and we can't take a trade at this point. What we need now is the price to come back off here, give us a clear confirmation, and we would be good for entries. Now for confirmations, you can also use candlestick patterns, just like how we discussed earlier on. Incorporate them into your trading, and it would even make it much more easier. Now for the fact that you watched the video up to this point, I strongly believe that you are now fully equipped with the right knowledge to go over and start making money. I mean, I have just shown you my whole, honestly, trading journey from A to Z. And by the way, more to that, I have over 100 videos on the channel where you can get to learn, watch, and just get as good as possible. And then on the other side, if you are a passionate trader and you're looking at fastening up your whole trading track in the shortest time as possible, then this is for you. I do run an academy of over 1,000 students. Now keep in mind, these are people just like you. You guys remember when I started the video and showed you results? These are people just like you, but making tremendous results. And this means it's actually very possible for you. But it only comes down to you taking action right now. So I'll go ahead and put the link just down in the description. When you click that link, it will take you to the best trading academy in Africa. And then you'll be able to get access to myself and then 4 other millionaire mentors. Then more to that, you'll have 5 Zoom trading sessions every week, Monday, Wednesdays, Fridays, and then Sundays with myself and these other mentors. But then more to that, you will have access to an exclusive community of winners just like yourself. Now, honestly, in here, there's nothing to lose, but way too much to gain. And for the fact that you watched the video up to this point, this is a true calling for you to get inside. And remember, the moment you're in, there is never looking back. And by the way, remember to like and subscribe. And I'll see you in the next one. Cheers.